Hi, everyone, and welcome. Excited to be the first panel after a keynote speaker, and it's great to have kicked off the morning with a focus on sustainability and trends around the world, both from a regulatory perspective and how the market is changing. We wanted to take this dialogue further today and kick off our panel, which focuses on the topic of environmental, social, and governance investing. What are the opportunities and challenges in this space? And for anyone who's been in the finance world, especially if you're investing, you cannot miss the term ESG. It seems to be the gold rush of our generation, where money is flowing in and it's the biggest marketing buzzword. And according to Bloomberg, by 2025, $53 trillion of assets, which is about 1/3 of the global assets, are going to be labeled or tagged as ESG. So as we think about this, and ESG being a new phenomena, what we wanted to talk about today is what is ESG? Let's get on the same page, or sustainable investing. What are the challenges as you think about a new topic? If you think about GAAP and IFRS, let's think about the years and years it took to develop those standards. And then what we want to talk about is really the focus of ESG and how we will move forward. So as we go through it, I have a really exciting group of panelists joining me here. Nancy Mata, she will kick us off, and she is a SVP of Wealth Management at UBS. She's been in the space since 1980, so I think she can talk about the evolution of how has the world of sustainable investing evolved. Along with her, we also have Eli Reisman, who actually was one of the first few people to work on Sustainable Accounting Standards Board, which is really the de facto emerging standard in the US and globally on ESG and how do you think about environmental social governance issues. And now he works as Associate Director of Product Development at FactSet, where he'll talk to you about the latest tools and technologies and data that's available to help assess this space. Additionally, we're going to get a practitioner's view from Irene Chan, who's the Director of Accounting at Swiss Re. She's going to talk to us about the real challenges as the asset management group launches green bonds. How do you account for it? And the nitty-gritty details of taking this broad topic and bringing it to life. And last but not least, we have Shaurath. Shaurath Chopra is a professor at the City University of Hong Kong. And what I love about what he's doing is really helping. His research focuses on what are the key indicators of sustainability for the built environment, and will push the dialogue to saying how can companies start really avoiding greenwashing in this space. So with that, thank you very much, everyone. And I look forward to kicking off the conversation. And maybe, Nancy, I'll start with you in just introducing the panel or introducing our audience to what is ESG or sustainable investing. Can you kind of help us understand the journey?
Sure. So first, it started with negative screening, and that originally where you would eliminate certain things like adult entertainment, alcohol, fossil fuels, gambling, nuclear power, opiates, tobacco, and weapons. So now it's progressed, because that was exclusion and we weren't looking for performance. We were just looking to do good with investing. So now the environmental, social governance, and I'll go into specifics. So the environmental part is climate change, energy efficiency, water management, waste management. The social part is product quality and safety, labor relations, employer health and safety, community relations, supply chain management. And the last is governance. That talks about the broad structure, board diversity, how many women are on the boards, minority, executive pay, and business ethics. So it's really expanded. And back in 2015, the UN came out with 17 sustainable development goals. And many of the companies are trying to adopt as much as possible of those goals. So I have found that it's really has progressed, and really my clients are looking for investments that follow their values. And that, especially the millennials, as they're coming up of age and are inheriting new money, they're more and more, it's very important that where they're investing, what they're investing is according to their values.
And do you see a disconnect between values and value, or is the purpose of some of these items really to focus on value as well?
I think it is changing, and I think in the past, and this is one of the challenges, and we'll talk about it later on this panel, is it's become the buzzword. Everybody is looking for sustainable investing, and then everyone's looking for impact investing, and then they're just adding that word in their title, and so you think, oh wow, we're investing. And I think what we're finding, for instance, impact investing, which is it goes beyond ESG, because impact investing is actually quantifiable, and their goals, and every quarter they have to say, this is how we're doing on these goals. And if they're not accountable and there's nothing showing that, then it's not impact investing. And that's very clearly a difference.
Yep. So that's really helpful. And Eli, maybe I'll jump to you. What are the issues you're seeing? So Nancy gave a broad overview of what are the topics that make ESG, but what are the issues, and really why is that issue important?
Sure, yeah. If we break ESG into the three major pillars that Nancy talked about, the environment, social, and governance, when we look at the environmental pillar, the issue there's in all three pillars, there are issues that rise to the top, right? The ones that are more important. And when you think about the environmental pillar, climate change and climate specific focus is definitely the theme that's most important at the moment. And there's a strong drive in the industry to create products that identify not only companies that are performing well on climate metrics, but are also not only looking at the companies that are performing poorly on climate metrics to do the negative screening that Nancy mentioned, but also the companies that are performing well. There's more and more investors that want to reward companies that are at the top of the pack. In the social pillar, there's an increasing interest in the way that companies treat and affect both employees as well as customers and communities around them. This actually, we've seen a sharp increase in the interest in these specific metrics since the start of COVID-19, where one's workplace and how an employee is treated can have a massive impact on their health as well as the health of the community around them. So that's really the theme that's cropped up the most in the social pillar. And then in the governance pillar, the focus is almost always around how well is the company run? Is the company being run using best possible standards? And investors want to know if the board is independent to ensure that the right incentives are in place to make sound business decisions. They want to know if companies are engaging in corrupt practices that could result in fines or lost business. Those are the real theme is the business being run in an appropriate manner in that governance section. So in terms of the three themes, those are the most important themes that pop up in those three pillars.
Got it. Yeah, it's how well a company is run is really what these indicators are telling you beyond the revenue and digging into it. But in order to tell that story, we've all who worked in this space have seen a lot of greenwashing and data challenges. So Sharad, perhaps you can talk a little bit about, as it grows, where is some of the challenges you've seen as you look at some of these funds?
Sure. So what I've realized is I've noticed that ESG fund managers tend to argue that, similar to the traditional investing decisions based on financial reporting, where you'd have multiple analysts look at the same data and interpret the data in different ways, the same way ESG space would also emerge in such a way. And I think that's an acceptable future for ESG. However, the non-financial disclosure methodology is not as rigorous as, say, what we have for the financial disclosures. And that's where the problem is. So the methodology lacks consistency, right? And that means that the data that we are using for making or comparing companies or firms, based on their ESG disclosures, lacks credibility. Right? And one big issue methodologically is the lack of information or data from this life cycle or the value chain of a company, right? So by that I mean the upstream supply chain and the downstream end of life of the products made by the company. So, for example, we've spoken about the E pillar, right? The environmental pillar. Within the environmental pillar, we have waste management, but we don't really talk about plastic waste specifically, right? And plastic is a big issue, but we've still wrapped waste as a whole and not really been more specific, because ultimately reporting is one thing, but making decisions on these reports and improving your performance over time is critical, and that's a problem. So any ESG investing decision that does not take into account the data from the supply chain is basically ignoring both risks and impacts, right? When I say impacts, you can think about carbon as an example. You can ignore a lot of the impacts associated with the production of those materials that are in your supply chain, which does not really come into the boundary of your reporting in scope 1 and 2 that is mandatory. It's becoming slightly technical here, but the point being that you're ignoring the impacts that are emerging from the upstream supply chain, which is a considerable portion of the emissions, right? And if you are making decisions without taking that into account, you're basically creating ESG as a tool for greenwashing rather than a tool for good.
And I'll bring an example that often comes up: Walmart versus Aldi. If you're saying which of these two is better from a carbon perspective, I don't know their numbers. Walmart owns all their trucking fleet. So that goes into Walmart's own carbon footprint, and Walmart would report it and they come off as a heavy emitter because they own it. Versus Aldi outsources their transportation. So Aldi looks like they have a negligible carbon impact. So realistically, if if an investor were to look at those two companies, how are they really supposed to think about how efficiently are they reducing the emissions from their transportation? And supposedly Walmart could be perhaps better because they control it and they manage it more tightly. So how do you think about this entire supply chain to understand the net impact of the company rather than just what the company manages to make some of these items comparable? And there isn't a unified standard across the board. So I get it. And actually your comments, probably Irene deals with the reality of bringing some of these products and green bonds to life. Maybe Irene, if you can talk a little bit about the challenges that you find as you help Swiss Re's asset management business launch some of these products or consider buying some of these assets.
Sure. I guess I can talk about it from two different perspectives. One is from the investor standpoint, one is from the issuer standpoint, and I actually deal with both from my company's perspective. And I'm pretty sure many companies out there are also doing the same thing as well. So maybe let me start from the issuer perspective. So I think one of the common elements that you see is that, companies normally they issue debt to the market, right, to get financing. But now they're thinking about adding this additional element to it, which is to incorporate some sort of maybe ESG goals, right? So say if Swiss Re or some other company, they meet certain predefined ESG goals, then we are saying that we embed it in the debt issuance and we can pay maybe a lower interest rate to the investors. But if we don't meet the ESG goals, then of course, then we end up paying more to them. So we have all the incentives to meet the goals. But with this additional element that I'm adding on it, now suddenly from an accounting perspective, we may end up having some unfavorable accounting treatment. So we wanted to do good, to incorporate all these good things, but at the same time, it may cause us to have unfavorable P&L or financial impact. There's a a balance there. Do we want to do that, or do we not want to do that? And then also it may also force us to have additional footnote disclosure, which also drives us costs as well, right? Because the company now needs to set up data and everything. And going back to the data, how reliable is the data that we are reporting, right, to the public? Like, do we just show them some number and people just believe in it, or they want more to it? So I think these are some of the accounting consequences or situation that I see from an issuer standpoint, that really is not just about accounting, because when we make an announcement about a ESG related debt issuance, finance, HR, treasury, all the departments really have to come together and think through what is the accounting consequences, and do we want to go for that. So that's from an issuer standpoint. It's one of the side that I see, but also from an investor standpoint, there's so many green bonds out there, right? We are so excited, but then now we need to assess those green bonds. That's when the issue comes in. There's a big data issue, right? Can we go to one source to get all the data? Maybe, maybe not. Most likely we cannot, right? But and then are we going to question how reliable is the data? And then I was like, okay, even if we can get reliable data, where do we store them? Do we need to now set up a new system, a cloud, space to host them? And then who's gonna own the data? Is it me as an accountant, or I'm gonna go to the asset manager and say, you own the data? Who's gonna keep track of the changing data? And then most of all, I think, is how much money is it gonna cost us to do that, to make sure we have reliable data? So I think this is not simply an accounting question or setting up an accounting ledger. It's the whole carbon ledger. It's the whole process, controls, system, technology, infrastructure, the whole thing, to really ensure at the end of the day we have trustable data, so that it helps us to make good decision in the deal making process. Should we invest in this green bond, or should we not invest in this green bond? And ultimately, after we invest in the green bond, now we have the question about reporting it in a disclosure. And I think when I'm looking at the international accounting standard, it may be more than just disclosure. They may be telling us, now you have to think about your impairment model, right? When you impair your bonds, you may need to consider the credit risk element. And then the question comes, how do I incorporate that in my impairment model? Where do I get the data, reliable data? What rationale should I base it on? And this is going to be a direct P&L impact if I impair something. And so everyone in the firm are so cautious about this. So I think this is a big data issue overall, I think, when it comes from an investor standpoint, that I see from an accounting perspective.
Yeah. This is the nitty gritty that I don't think often the sustainability conversations talk about. We talk a lot about the customer view, et cetera. But to bring this back, Nancy, Irene talked about the institutional customer view as they consider these bonds, their understanding of the challenges. Can you talk about the retail customers that you talk to, the high net worth individuals? What are their challenges as they try to understand this landscape of sustainability?
So the biggest challenge that we find is exactly what has been talked about before, which is trying to really do the deep research. I actually have a group that specializes just in this area, and that's all they do is dig down deeper, and it takes a lot. And I think that the individual investors really want to make sure that what they're investing is exactly what they said. I won't name the fund, but there is a major fund out there that just put that they're energy, related. And so people may think, wow, that stock or that fund is appropriate. But then when we dig into it, we found out that more than the biggest holding in that fund was Exxon, which if you're really environmentally sensitive, you do not want Exxon in your portfolio. So I think the biggest challenge is actually finding the true value out there, and there is, and it is available, and you can make money, and that's, I think, the biggest change is that in the past, if you were looking at value, that maybe you gave up some in the performance, but we are finding that you actually can outperform. I mean, we have certain managers that have been outperforming the S&P 500, even with all these parameters to make sure it's sustainable. And so it is possible. And what I was going to say before is that if you have two companies that are financially identical, you know, you look at their spreadsheet, everything's the same. What's going to make the difference? Non-financial factors like how many women on the board and all this, and it's going to become more and more evident. So that company is going to be highly competitive and will win between those two. And so I do think that investors are looking for people like me to help them find the right companies and the right funds that actually are not greenwashing, as we have said before. And that's what I think investors have to be careful. And I think they really do need advice and guidance. And that's where we come in.
Yeah, no, those are really good points when you talk about energy transition funds, and none of the holdings have really made a serious commitment. You're in deep trouble. And I'm already seeing questions pop up on this topic. So hopefully in our Q&A session, we'll dig a little deeper on it as well. So just, you know, we know there are challenges, and the main challenges lie in a few areas. The first is data and what are companies reporting on. Second is, well, how do investors, both institutional and retailers, understand how to think about this data and make their choices, and really educating the consumer. So maybe Irene, if I could move back to you, how do you see reporting standards evolve and bring standardization to some of the accounting challenges you've brought up?
Sure. And I think from an accounting perspective, we are concerned from an accounting guidance, but there's actually many different sustainability reports out there that companies somehow have to maybe comply with. And I think the FASB from the US and the ISB from the International Accounting Standard perspective, they are in the process of figuring out, okay, what are the additional disclosure they're thinking company need to then comply with. They are working on it right now. They haven't really announced exactly what that is. And so I think it's actually a good thing that they wanted to come out with some guidance, because that really creates standardization, which is a good thing, I think, overall. But the key is, how do they do it? I think from a company perspective, the worst thing is that there are seven reporting that I have to do, and they're all different. And then they require all different disclosure. And I can imagine company is going to die from just reporting, right? Complying with this exercise. So I think the two different framework, and I think most company as international company, you cannot avoid. It's not that, oh, I'm only in the US, so I don't care. All the international company, you work in other countries. So basically each company almost have to comply with both US GAAP somehow and maybe IFRS, right, guidance. So I'm hoping the two accounting setting boards are going to consider other sustainability report that are already out there before they create their own, and then really work together to create maybe one single set of globally acceptable disclosure or requirements. Otherwise, company is going to really have to drive up their costs. And that is not going to help with this whole green initiative overall, because they only think about, oh, now if I involve in it, I have this exercise where I have to report to 7 different agencies. That's all they're going to concerned about. And that really defeats the whole purpose of why having such a standard is good for us. I think it's heading in the right direction. It's just that I hope they all work together, really think through it before they disclose what they want us to comply with. And then the other thing is that good quality disclosure requires time, right? So they need to phase out maybe the way they issue out the guidance and really give company time, because then they need to put together a good control process, system, everything, in order to really collect good data to comply with the requirements out there. And also, I think once they give them time and eventually do that, I think it actually helps with this whole data issue, because now we have to enhance our disclosure controls. We need to report to auditors. They're going to come in and question us how we report those numbers. And then we need to obtain officer certification. So I think it's all a good thing. It's just really how they're going to do it. really is the key there.
And are you seeing anything? One of the things you talked about is the green bond standards and what's coming out of Europe. Is that really helping with some of the accounting challenges you've raised? Or is that much more about what just constitutes a green bond?
I think it's just what constitutes a green bond. It's not necessarily about what need to comply. Like usually, when you go to every new accounting guidance, they tell you, okay, there's a 5-table, 10 extra disclosure you need to do. So I think maybe they can learn from it, like the accounting setting bodies, they can go to those existing guidance and maybe incorporate in how they develop the new disclosure. And hopefully they are very similar in nature, so that as a company, I just need to basically collect one set of data and then I can report to all the different reporting agencies.
Yep, that's helpful. And Eli, it would be great to kind of turn to you and think about what other approaches are investors using to address the bias and the lack of standardization that Irene just mentioned in company reporting.
Yeah, we see this all the time, and it's something that I've been building products to help deal with for the last 5 years. So, the reality is most investors, especially on the institutional side, that are very serious about ESG and digging in and finding those answers of how companies are performing, have come to the conclusion that simply using company self-reported data is not enough. It doesn't provide the full picture, for all of the reasons we've been discussing. There are holes in the data. It's not standardized. You're sort of missing key elements in the supply chain. And so in order to get a clearer picture, investors are starting to buy data sets such as the ones that I've been working on, where we're using artificial intelligence to uncover ESG data from unstructured text. So you're able to mine hundreds of thousands of pieces of text and identify how companies are performing on ESG issues, and catching issues that a company may not be reporting themselves. You're also seeing more and more data sets using satellite data to capture greenhouse gas emissions, to better track how companies are performing on greenhouse gas emissions as a whole, because right now, you may only get scope 1, and if you need scope 2 and scope 3, it's tougher to get, and you may have to sort of model that or find other ways to get that data. So, I think these alternative ESG data sets are being used more and more in the vacuum of not having standardized data in the way that Irene is talking about. We're all hoping that FASB and IFRS start to draw a line in the sand and say this is how companies need to report and do it in a standardized way. But until we have that, the companies are going to continue, or investors are going to continue to want a fuller picture of how companies are reporting on or are performing on ESG metrics. And to get that, it's really about finding other data sources other than company self-disclosed information.
Yeah. I know, there's a strong bias to only report what you're good at. And that means you're definitely not going to report things where you look really weak or have challenges. And I think your products really help uncover that. But beyond, to avoid this greenwashing, I know there's regulation coming out of Europe. Can you talk a little bit about a regulatory perspective to also address this challenge, especially on company reported data?
Yeah, absolutely. I mean, the EU regulatory framework, which covers not only how companies need to disclose ESG metrics, but also how investors need to disclose their ESG investments and the metrics on those. And it also encompasses the green bond standards that Irene touched on as well. This is a framework that is really creating massive shockwaves. It's the first time that ESG data is being mandated in terms of how it should be disclosed. It is certainly not a perfect system. Irene mentioned that phased disclosure is a useful thing to be thinking about. The way in which this system is being brought in is sometimes not phased in the right ways and is causing issues of, we don't have metrics on the company side to disclose on the investor side and those types of issues. But the fact remains that this is really the first time a major regulatory body is mandating ESG disclosures in a standardized format. And it's going to have huge effects in terms of allowing investors to have a standardized data set to compare one company against the other. And in going back to Sharat's initial point about, looking at greenhouse gas emissions up and down the supply chain and how that could affect a company, it will be, scope 1, scope 2, and scope 3. I think scope 1 and scope 2 is part of the initial mandate, and scope 3 will be phased in as part of the EU regulatory framework. But when you have all three of those, you can finally have a clear view of how a company is performing up and down the supply chain on these types of issues. So, the market has seen this problem, and the EU regulatory body is trying to solve it. Now, the bigger question is what happens when the EU has its own set of standards, and then the UK, the US, and all these others start putting their own standards in place. How do we, where's the consolidation point? Is it IFRS and FASB that need to be those sort of key central holders of what a sustainability disclosure should be? I think that's the real question right now is, how do we get to the consolidation of these are the standards and this is how everyone is expected to disclose? Because right now it's only affecting companies in the EU and then financial market participants that provide products in the EU.
Yeah. Now, this is really helpful. It's similar to the evolution of the GAAP standards, and then we go to IFRS, right? There's the UK GAAP, the US GAAP, and Irene probably deals with that on a regular basis. So definitely we're running out of time on these sustainability issues, but at the same time, these standards aren't evolving fast enough. But hopefully, I think we're moving towards consensus. And for those in the audience that may not be living and breathing ESG regulations, what the number of different standards or voluntary bodies are now starting to consolidate, and we're starting to see regulations really driven out of the EU, and then also some efforts, voluntary efforts from the US and IFRS Foundation that we hope will bring standardization to the sector. So maybe Sharat, kind of coming back to you, talking about standardization, how can companies better use technology, which is some of the challenges Irene mentioned, to improve their reporting on ESG issues without creating massive data infrastructure challenges, but really trying to get to the bottom of what are their ESG challenges?
Yeah, that's a great question, and I'd be basically bouncing off what Eli was just mentioning. That okay, let's assume that we have all of these standards set, everybody agrees upon them, and we have the methodology agreed upon, and that so that everybody is using the same methodology, right? It's a big leap of faith, but assuming that happens, the other issue that we've spoken about, and Irene mentioned about data management is going to be a major sort of limiting factor here of how fast we can actually do the transition to actually do proper reporting. And the issue right now is that the listed companies have to do the reporting, but the data is with the SMEs in their supply chains, right? And if you have to actually have that data collected as well. So a good example of that is textile industry, right? So you have, say, one of these fast fashion companies. You look at their supply chains. Most of them are in Asia, and then there's this implication of, well, how do we get data from these companies that have no interest in collecting data, right? At least the listed companies have a responsibility to provide the data if they are listed on on stock exchanges. But on the other hand, these SMEs don't really have any purpose no goal, no incentive for them to invest in data collection, data management. So I think that there needs to be some sort of a digital transformation that is anyways happening to be integrated with ESG. And I think technologies such as smart contracts and blockchain, where there's allowance of encryption in terms of what data is available for viewing to different stakeholders within say a private blockchain that is set up for specifically collecting just data for on ESG KPIs and made available based on pre-agreed uh, arrangements. And this would allow sector-specific requirements. So you'll have sector-specific sort of databases of blockchains, however you want to think about them. And this doesn't really solve the problem of garbage in, garbage out, to be honest, right? Like you'll still have terrible data coming in and you'll have bad reporting. So they ultimately needs to be, we need to have penalties, right? So SEC has penalties for terrible or malpractices in financial reporting. What about penalties in malpractices in ESG or non-financial disclosure? We need to go have that conversation as well. So yeah, these are some of my points. I think the digital transformation is going to be key for allowing the collection of data and storing it and encrypting it.
Okay. Yeah, I completely agree with you. There's a whole data collection process and management process that both Irene and you have alluded to. And then, well, what are the standards to which we collect and report this data? Both Irene and Eli talked about it. Great. Now we have all the data. Nancy, how do you educate a customer that comes to you and says, I want to invest my portfolio and I want to make money because I don't want to lose money. Can you talk a little bit about what are some opportunities to educate clients and how are you approaching it?
Well, actually, this is one of my favorite topics to talk with clients. It does come up a lot. So what I do is I use the statistics because people respond to statistics. So I'll explain to them the different companies, like for instance, Johnson and Johnson, they're involved in the opiate situation. So do you really want, your portfolio to have Johnson and Johnson? We do a deeper dive on particular companies just to educate the client. And once they start to hear why this makes a difference, they come on board and go, okay, they want to know more. Obviously, they don't want to know every little bit. That's my job. And they want sort of an overview. And so, we have quarterly newsletters that we send out to clients to talk about this, area or that area, and just educate. Because another area that I did mention that's becoming very important, especially in the C-suite, is the diversity, the DEI, diversity, equity, and inclusion. With the Me Too, what's happening, that's also, it's not only just environmental, this is the social, and we're finding that it's now left. It used to be sort of middle management was dealing with that, and now it's gone up to C-suite. And again, we explain this to clients, and they're very interested, again, at the high level. They don't want to know every little bit, they want to know that I've done the research, and then I give them the list of the companies, and then we could go over individual companies as to why. Why is this company in the portfolio? And they love it. I mean, they really want to be educated.
Yeah. I think understanding the stories or a few data points, because understanding the breadth of data is almost impossible. I don't understand the reason why certain companies on my portfolio just for financial performance. So to add that to an investor's understanding is definitely a challenge. I am seeing quite a few questions on our Q&A board. So instead of going further into questions, I'll go through some of the questions that are popping in the board, but just before we get there, I wanted to recap the panels and the discussion so far. We started with the definition of E.
Is it me or is it a connection?
Amisha is frozen. I think I can hear and see everybody else just fine.
Oh boy.
Maybe in the meantime, maybe I can just quickly ask some questions that was outlined, and then maybe hopefully Amisha can come back in
Okay.
the meantime. So let me just maybe start from the question. The first one I see is it mentioned the financial industry is challenged by the mandate to generate results for their shareholders versus modifying the business model to drive and support ESG agenda. How well is the industry doing to deal with this challenge by reducing the dependence on high return non-ESG business to maybe lower return ESG supporting business? Maybe Nancy, is that something?
Yeah, well, but I think that sort of was, I think that's what the past was. And I think it's changing because I have portfolio managers that are outperforming the S&P 500. So when I tell clients that, they go, oh, okay. You know, again, not everybody is as concerned. It's just that when they realize, oh, okay, I could still make money, but also do good. Why not? And so I think it's, I think that's actually one of the challenges out there is that people have this, the past, which was true. In the past, if you were trying to be socially responsible, for instance, you got rid of Altira because of tobacco, that your performance probably wasn't going to be as good as the next guy who had Altira. So I think that's changing dramatically, as I said, because again, I'm trying to also create performance for clients, but do the right thing. And we are finding that it is available and possible. So I think that's going to change. And that's how I educate clients to show them that. And they love to hear, and I show them the statistics. So I'm backing it up. I'm not just making it, oh, it sounds great. You know, here are the numbers, and it's impressive. And again, that maybe 20 years ago, 40 years ago, when I first started in this business, that again, we were only looking to eliminate things and not really, this whole ESG thing was just at the infancy, really.
Yep,
if I could add on to that, Irene, just to riff on top of what Nancy is saying, you know, there's also hundreds of, maybe thousands at this point, academic studies looking at ESG funds in comparison to non-ESG funds and looking at performance. And what they found, I mean, like the vast majority of studies found that there's little to improved performance from ESG. It's actually, you know, the net effect is oftentimes better performance now. As Nancy mentioned, you know, now that we're sort of out of the negative screening area and we're looking at actually tilting towards better performing companies, ESG oftentimes is a good proxy for good management within the company. And therefore you're seeing, you know, better performing ESG companies actually better perform on the whole. And in general, the ESG funds are actually performing well against their peers and oftentimes better. You do get some ESG funds that underperform, that's going to be true. And just like any other fund, but I think ultimately it's not hard to find an ESG fund that's outperforming its non-ESG peer. And I think performance, you know, the girth of academic research on this is actually pretty compelling and worth taking a look into.
So at the end of the day, it's more like almost a win-win, right? It's not that now you invest in ESG fund, you're going to suffer the return. You can actually go in the same direction at the same time for the firm. That's good.
Irene, can I also point out that, you know, when we'd be talking about business models here, we'd be talking within sector comparisons, right? So it's we would be doing like for like comparisons. If you are in a sector that has terrible, say, environmental performance, you'd be compared with your peers and not, say, a different sector. So I think, there's no sort of ESG agenda. It's actually an ESG requirement.
That's a good point. That's a really good point. Okay, so kind of along that side, that there's a really good question that comes up as well that talks about Many senior managers now are getting bonus, and their bonus may be dependent on this ESG agenda that the company set out for itself. What can be done at the board, I guess, or at the shareholder level to change the incentive or reward action for this kind of common good that we wanted to do rather than just about profits? So I don't know, maybe Eli or someone, you want to take it up?
Yeah, I mean, I think the answer is almost within the question itself, which is you have to align your incentives to align with the outcomes you want to see within the company, right? So if you're giving senior managers bonuses to align with specific ESG outcomes that you want to see within your company, you're far more likely to see them than if you are aligning your bonuses for other reasons. So I mean, if you're a company and you're really looking to improve performance in different ways, simply, I think it starts with measure. What gets measured gets managed oftentimes, and so as you said, Irene, there's all these different standards out there right now that companies have to think about today. Do we disclose GRI standards, SASB standards, the EU regulatory framework? What are we doing there? But I think it's figuring out the standards that are right for you as an organization. And that's oftentimes a materiality exercise and finding out what matters most to your company. And then it's also aligning the incentives internally to manage those metrics in a way that makes a material difference.
Great. Kind of along that line, right? I know we keep talking about climate risk, now it's about company compensation, about return. But when I was doing my research and also encountering out there when it comes to disclosure, they also talk about diversity inclusion, right? D&I. It's almost like it's a complete different topic, but it's not so much the case. I guess, do you have any feedback or a comment on that particular matter?
Are you asking me?
Yes, Nancy. Do you have clients asking you those questions too?
Absolutely. Well, it's now top of mind because of the Me Too, and we are finding, if you have a company that more, 50% or close of the board is women, that the company seems to be doing better. Now, again, it's governance, and so it may be like this is the right thing to do, but I think from a financial point of view, it can be leads to profit, and it's just the governance. And again, if we're looking at two different companies, you're going to start to look at these non-financial factors, and I think they're really important. And this is just top of mind. The other thing I wanted to bring up is, that it is the C-suite is now really looking at this. And before I think it was just one of these topics that, not a pain in the neck, but it was kind of like, oh, this is one more thing we have to regulate. But now, because of all the publicity and everything, social media, it can't be avoided. And that's a good thing. I really think we're heading in the right direction. And that I do think that the next 10 years is going to be very significant in this area. And those companies that are ahead of their peers, I think are going to outperform. And I think that people should be looking at that. Yeah.
Great. Perfect. I guess maybe one of the key thing, I guess, in the past 45 minutes when we talk about it's going back to data, right? So I kind of want to go back maybe from that point of view. So from a data perspective, we identify all this issue, but I guess what is one of the potential solution to really deal with it? Like, are we looking forward to maybe one data source where everyone can go to that and get it, or how do we kind of potentially help to solve this issue?
Well, I have an opinion that having average data sets based on databases that have been compiled are problematic. They are not specific enough, and so ultimately, in my opinion, it should be company-specific information. And I think we have the technology to do it. It's just the will that is missing.
I see.
I think we need to end our session.
Yes.
Getting the people.
Yes. But with that note, that really concludes everything I think we talked about today. So hopefully we gave a good feedback to the participants. So thank you everyone for listening to this section. Thank you everyone.
Thank
Thank
you.
you.
Thanks all.
Bye.
Bye-bye.